All right, great. Welcome to 758P, Equity Analysis Valuation. My name is Joe Perfetti. I'll be the professor for this semester with you for the next 7 weeks. I also teach a regular version of this, interestingly, for physical class, which was just canceled for the next month, and they all moved online. So it's kind of fortuitous that we actually have this online class because all my regular students are going to be taking a version of this going forward. We're also going to be using Zoom, so hopefully everybody's having no issues using this version of Zoom, just because, as you probably know, the software that they were previously using does not work very effectively. So this Zoom will allow you to share as necessary as we go in the next few weeks. And again, we can record sessions and use my desktop efficiently. So a couple just administrative items as we get started here today. I've been teaching at College Park now on a part-time basis as a lecturer teaching this class going back 13 years. Do an undergrad version of this, as well as the MBA and online MBA and a master's version. Basically, what I'm going to be talking to you is equity analysis. Obviously, it's somewhat of a real world class in terms of the models and discussions that we are going to be talking about would be used in the real world during normal times, which we are no longer in. But nonetheless, as we go through this session, and I'm going to go ahead and share my desktop. So, as I said, we are recording the session. Whoever's doing the feedback double loop, if you can put your computer on mute or plug in some headphones, that would be great. So this class will be 7 weeks. Essentially, what this class is about is what I would call the sell-side valuation of equity analysis. So kind of like how a bank would write a buy, sell, hold opinion on a company, and what are some of the things that they would do to understand that. Today is going to be more of a general overview to the concepts of valuation. And then there's going to be 4 major frameworks that we're going to cover this semester. The first major framework will be week 2. It's a framework called EIC, Economy, Industry, Company, which talks about external analysis and how that drives valuation. The second framework we'll be talking about in week 3 will be historical analysis. We rearrange financial statements into an economic format in this class, kind of a cash flow driven model tied to Modigliani Miller. And there's 2 types of historical statements that we will analyze for companies. One is called an ROIC tree, which helps us understand the drivers of ROIC. The other is called a cash flow analysis, CFI. And we will be talking about how to analyze and interpret those rearranged statements. Week 4, we'll talk about, and week 5, it's kind of a 2-week process. We will build a real world valuation model. So if you're not familiar with Excel, by the end of the semester, you will be. And so you'll be building an Excel model that's tied to Bloomberg. And by the end of the semester, we'll do a valuation together over 2 weeks. And then you're going to pick a company and teams, which is going to be a big portion of your semester grade. And basically, you're going to do a valuation on that company as well. And I'll help provide some data to do that. But you're going to build the model to do that in weeks 4 and 5. Week 6 will be the 4th framework, which will be on multiples analysis and how we can do enterprise value, price to earnings multiples. And then the final week of class, like I said, you'll have picked a real world company, and then you'll do a valuation and presentation to me, 20 minutes during that class for a grade. And that's kind of how we'll tie all the frameworks together. So the general idea is, with the exception of this week, each week covers a framework. We'll do homework and discussion on that framework. And in parallel, 1 week behind that, you'll actually have a company that you'll be doing that with as a group for a group long project. So individual assignments to practice, group semester long project, 7-week semester that you'll do for a grade. So that's just the general format for the class. Obviously, pay attention to the announcements and the assignments. And then obviously you can see what our grading schema, oh, wrong one, this is the grade book, grading schema is. But one of the first things that we need to do, and hopefully everybody did this, was essentially assign yourselves to groups for a grade. And it looks like we have 6 students who did not do that. So I'm going to take a screenshot, figure out who doesn't get credit for assignment 1. And that was 2 points of your semester grade, which is really easy. But you can see that for the 7 p.m. section, we have 3 groups. We can have up to 7 people per group. So if you are one of these 6 people, you need to be in one of these 3 groups. All right. So is Ellen Choi on this call?
Yes, I am.
Okay. So you're
I actually joined under the student groups tab. So that must be not the right place.
well, it's the one that says the 4 grade. That's the important one.
Okay. I'll go ahead and join.
You're now going to be, do you want to join you want to pick a group? Do you want me to assign you?
Yeah, that would be great. I mean, just anywhere is fine.
Great. You're now part of this group too.
Thank you.
Emily Cobb, are you online? I'm going to really bastard this name. Is it Ilkikalu? Karam? This person? Are you online? Okay. Michael? Michael, is it Piscatelli online? Mark?
Yeah, Professor, I'm here.
Mark?
Yep.
You have a preference for any of the 3 groups?
No, whatever's open.
All right, I'm going to put you in with group 3, just to be different.
I also thought I had joined a group too, and we were even exchanging emails, but.
Yeah. And William Sherman, are you in a group? William? Then I'm assuming these 4 people either aren't here or in the other section. All right, so these are very important groups because for this group project, as I said, it's going to be about half your grade this semester is going to start working, after next week on the group project when we assign that. So look for that coming up. All right. So as I said, today I put in the announcements folder a lecture note called Lecture 1, which we're going to cover in class, which will also cover some of the content that we were discussing in the online readings and the videos for the class. Generally for this online MBA, there are videos which were recorded in live classes that I did at College Park. I'd done screen capture on my laptop. They were edited down. So if you hear references to certain things or people talking, you might have heard the people in the class. But nonetheless, those were the content lectures, and there's reading the book. So hopefully when we get to the class, we can focus mostly on application and questions. But as the online MBA, it's basically up to you to kind of keep up with that and to do the assignments and then ask questions as we go through as a format. All right. So in terms of content, switch my share here. Stop this and reshare the desktop. All right. So this is the lecture note. And what we're going to be talking about is a summary of kind of the overview today of valuation, which basically we're using the McKinsey book to highlight it. And we'll talk about the 4 cornerstones of valuation in just a second. But I want to give us some context about how valuation is changing. Just 2 charts that are very useful for us to understand. One is the first chart on the left basically talks about how long it took to get to 50 million customers historically. And it used to take decades. Now with technology, Pokemon Go got to 50 million users from scratch in less than a week. And so the idea is that things are happening at a much faster time scale in the world than they ever have, whether it's disruption or anything else. And the other thing that's actually changing about finance, and this is just information from InnoSight, is by 2025, it's estimated that a company on the S&P 500 will only be there for 12 years. Or said a different way, we're going to lose about half the S&P 500 every 12 years, right? And that's either through acquisition, disruption, changes in businesses. You know, companies like JCPenney are going to go away, Sears are going to go away, and that basically the change, what's happening in the markets is much faster. A decade ago, you know, there was only one company in the top 10 in the world that was a tech company. A decade later, 9 of the top 10 companies were tech companies. So, you know, the only constant is change, and that's going to play a very important role to how we think about finance and how we think about valuation. So, 4 cornerstones of valuation. This is basically a summary of the reading and the themes that we're going to be covering this semester. First cornerstone is about spread. One of the things that we're going to focus on is that McKinsey's view is McKinsey's an ROIC consulting firm. And ROIC, and you're going to learn that tonight, is a proxy for free cash flow. So they're a free cash flow firm. They just forecast ROIC, which is a proxy for free cash flow. But the same core principles you learned in any finance class are applied to valuation, which is valuations about spread. It's the difference between the IRR and your discount rate. And over time, to have a positive NPV, your IRR has to be greater than your discount rate or your hurdle rate. Well, the same is true in the real world. The IRR for a company is called the ROIC. The hurdle rate for a company is going to be the cost of capital of the WACC. And over time, if you can't earn more than your cost of capital, you cannot create value. One of the other key points of hurdle rate is basically half of that hurdle rate, or sorry, excuse me, half of that spread is based on the industry that you're in. So industry is actually more important than company when we do valuation. So for example, historically, Warren Buffett even says, I didn't invest in companies. I invest in industries because they're more important. Then I selected the company that was going to win. Because I'll show you some data in a second, but I want you to think about this intuitively. If you're in a bad industry, it doesn't matter what you do. You're not going to make money. If you're in a great environment, you can be mediocre and still get a reasonable rate of return. So one of the tools we'll have access to this semester, and unfortunately, you're not at College Park, and even if you tried to be, it's getting shut down, is a tool called Bloomberg Professional. And I don't know if anybody's actually used Bloomberg before in this call, but this is Mike Bloomberg's company. It is the pro tool that if you work on Wall Street would be on your desk. So if you're working at Goldman Sachs or Morgan Stanley or Barclays or whoever, you know, work at Fidelity even, this is the actual software of which and how you would actually see the marketplace. It's got 1.2 million companies of real-time data, news, information, trading platform, etc. But one of the values of Bloomberg is somebody give me a publicly traded company. At some point, just unmute yourself, shout it out.
Microsoft.
Microsoft. All right, so I'm going to look up Microsoft. And one of the reasons why Bloomberg is a very powerful piece of software is it's probably one of the only tools in the world that can give you real-time industry averages. So this is a list of Microsoft's peers. And you're going to actually get some screenshots from me with some of this data. And these are their, I'll do this based on analyst peers for the US market. So these are US-based peers. And they have all these key data points like how much they've gone down the last month. But come over here to Custom, I clip any data point that I want. So one of the data points I'm going to look at is called ROIC. And it's going to ask me which ROIC you want. And I'm going to say I want the ones of the latest filing. So hit enter. And what's important is this column over here is the ROIC for the industry average. and then that's Microsoft and all of its peers. And it's what's called a market cap weighted average. So therefore it's adjusted for size, so a company doesn't actually distort it based on their size. So if I gave, this is based on the latest filing. So that would either be probably fourth quarter 2019. So if I gave all the companies in this list $1, they made 22.67 cents of after-tax profit, right? Proxy cash flow. If I gave Microsoft $1, they made 23 cents of after-tax profit. On Oracle, 15, etc. Right? Today, the WACC of these companies, so their risk-adjusted borrowing rate as an industry, takes a second, is 9.19. So basically, this industry today, on a risk basis, is borrowing at 9% annually. It's investing and it's making 23. Microsoft is borrowing at 9.26, investing and making 23.07. Is this an attractive industry? Okay. I would actually say yes, this is a very attractive industry. And by the way, when we get to EIC next week, that's exactly how we're going to define an attractive industry. An industry that has a positive spread. So one of the things in Bloomberg is I can actually save templates, and I have a template saved called spread. So I can just click on this little button and it'll just pop it up. So give me some other companies. Let's look at their industries.
Tesla.
I'm sorry, I heard Tesla.
Yeah.
Okay, here's Tesla and the automobile makers. So the automobile industry is pretty god-awful. It's a technical finance term. It's value destroying. Industry's borrowing at around 7 and making 4, 6.95 WACC, 4.03 ROIC last year. Tesla's doing particularly poorly, borrowing at 8.85 on a risk-adjusted basis and losing 1. And you'll see, with the exception of Ferrari, so if you build $500,000 cars, you're making a lot of money. But no one in this industry is doing particularly well, and cost of capitals are generally fairly similar for most of the firms. Give me somebody else.
New York Times.
New York Times. Sorry, I accidentally clicked off the screen. So we'll go back to their peers. Custom spread. So let's see how publishing is doing. This industry is borrowing at almost 8, making 6. New York Times is the one company in the industry that's actually creating value. Everybody else kind of sucks. Anybody want to show your employers, people you work for?
Marriott.
Marriott. This is, by the way, before the virus. So the hotel chains are actually doing reasonably well, borrowing at 7.6, making 12. Marriott borrowing at 7.7, making 11.5. Hyatt kind of sucks. Choice Hotels is really the star of the industry last year. I'll pick another couple. Here's Starbucks for the coffee addicted out there. This would be fast casual in the United States. My favorite is look at row 104, Domino's. Just throw some cheese on a piece of cardboard. It's extraordinarily profitable. In fact, I think Yum Brands announced this week that they're going to buy Monster or somebody. But fast casual is pretty good industry. Here is Pharma, Pfizer. So the reason I'm jumping around these screens is that I can tell you all day long that the academic studies say that 50% of your performance, plus or minus a little bit, comes from the industry that you're in. And some industries are more attractive than others, but it's much easier to show you. And that is the first cornerstone of value creation, is that over a cycle of a business, over the life of a project, you gotta have a positive spread. Otherwise, you can't create value. Which leads to the second point, which is part of homework 1, which is you can't create value from growth alone. Growth is the accelerant. If you have a negative spread and you grow it, it just gets warts off. If you have a positive spread, you grow it, you become exponential, more valuable. So it's the growth spread combination that matters. And this is the first cornerstone. Questions about that? Cornerstone number 2. It's about cash flow, not net income. I'll say it very simply. Net income is like a pay stub, all right? How much money you were paid at the beginning of the month on March 1st is not how much money you have in your account today. And if you don't have money in your account today, bad things are going to happen. Well, the same is true for a company. So as finance professionals, we tend to track cash, not income. Income is a representation of what the cash will eventually be, but the timing matters. In fact, we'll go a step further and say there's something called time value of money. Timing also matters because of that. So number 1, can't run out of cash, so we track the cash. And number 2, because of time value of money, cash flow more important than income. Excuse me. Cornerstone number 3, expectations. A company is worth the sum of its future cash flows. It's not worth the historical cash flows. As a matter of fact, I tricked you, all right? And what I mean by I tricked you is what's the problem with this slide? What's the problem with this data? And what do I mean by I tricked you?
Historical.
Exactly. We're looking backwards. And I like to say you can't drive a car looking in the rearview mirror. And that's what we're doing. We're looking backwards. We're scorekeeping, right? And when scorekeeping, I can tell you who won the last game. I can tell you by how many points or goals they won the last game. I can tell you a team's record. I can tell you how much their leading scorer scored. But none of that information tells me who's going to win the next game. And that is a representation of the difference between accounting and finance. And so even today, when we started with the data, I went to accounting, I score kept. And we started making determinations of who we liked based on what they did in the past. But what matters is not what you did in the past, is what you do in the future. Because I get future cash flows. I don't get historical cash flows. And ever since Chicago in the 1970s proved that you're worth the sum of your future cash flows, intrinsic value, we care more about the future. So it's the future, not the past, okay? So again, I'll summarize. 1976, Chicago created a very important database. They took 50 years worth of data from 1926 to 1975, and they put it into a punch card mainframe. And they put in stocks, bonds, and real estate, anything you could invest in on a quarterly basis. They put in cash flow, and they put in price. And in 1976, the quants did a bunch of regression. And what they found was a one-to-one relation over time between cash and price. Whatever the assets generated became their price in the real world. Made sense, because if I own the asset and that's how much cash they generate, that's how much cash I'd get. So that cash equals price. They proved that that's the way the world works over that 50-year period, 1926, 1975. By the way, they've replicated that study through 2019 and nothing changed. There's a guy named Jeremy Siegel who did it at Wharton from 1812 to 2010. Cash equals price. They've replicated that study at every other continent around the world. Nothing changed. So here's the point. You're worth the sum of your future cash flows. So where do those future cash flows get set? Well, if I am doing Pfizer, then there's something on Wall Street called the buy side and the sell side. Very quickly, this is the buy side. The buy side are the actual institutions that own your company. And Bloomberg is a nice tool because it actually tells you who those institutional owners are. And so on the scrollable list, 76.58% of Pfizer's shareholders are on this list. Their largest shareholder is Vanguard, which owns 449 million shares and change, 8.11% of the company, followed by BlackRock, State Street, Capital Group, Wellington, Bank of America, State Farm, etc. Okay, all the way down to Cedar Mountain, whatever the hell they're called, which owns 542 shares. And by the way, if Cedar Mountain buys 542 shares of Pfizer, nobody cares. It's not going to affect their stock price. All right. The people that really drive the stock price is when Capital Group buys 12 million shares or Bank of America sells 5 million shares. These are the institutions that are owning the stock, that are making the trades, that actually they basically determine the share price up here. It's not the 100 share blocks. It's the 10,000 shares, the 100,000 share blocks that are really going to move the price. This is called the buy side. And by the way, the challenge for the buy side is, let's say that I work for BlackRock and I am the fund manager of this BlackRock fund that happens to own Pfizer. And it just so happens that this is a very small fund. It has $5 billion worth of market cap, but it's got 4,495 companies in its portfolio. So the question is, even if I'm a small fund manager with this $5 billion fund, how do I keep track of 4,500 companies and all their competitors in all their industries? And the answer is, you can't. So what these fund managers do is they hire the sell side. So the sell side are specialists. They're the consigliere that basically write the buy, sell, hold opinions, and they do the market research. So the buy, sell, hold opinions for Pfizer are written by these analysts, which work for the banks. So it's going to be Vamil Divan of Mizuho, David Reisinger of Morgan Stanley, Carter Gould of Barclays, blah, blah, blah. And they write the buy, sell, hold opinions, and they set a 12-month target stock price. So right now, there's 19 sell-side analysts that are covering Pfizer. As of today, 9 say buy. Buys are worth 5 points. 10 say hold. Holds are worth 1 point. None say sell. On a 5-point scale, Pfizer's 3.95 out of 5. Today, their share price is $32.17. The average of all these analysts' 12-month guesses is 42. There's a 32% upside in Pfizer. They're down 19.5% over the last 12 months. That's what I would see. But here's the point. If I'm BlackRock and I'm trying to keep track of Pfizer, then I'll use Dave as an example. So Dave has a coverage universe of 17 companies. He is an analyst that works for Morgan Stanley. He's got an MBA and an undergrad on his team, and their entire life is to know everything they can about these 17 pharmaceuticals. And by the way, if you want to see Dave, this is Dave. So that's his phone number. That's his email, Morgan Stanley, if anyone want to ask him about Pfizer. So the point is, they write the research, which is the buy, sell, hold. But the buy, sell, hold is not for you and me. It's for BlackRock. And BlackRock pays for that opinion. So when he says buy and I hire him, I actually buy. And if he says sell, I sell. And they're doing the research. All right. Now, if he screws me, guess what? I'm going to go hire Louise of Cantor Fitzgerald. All right. But the other thing that these analysts do, and this is actually very important, is you can see the little spreadsheets here. They upload, MODL, their spreadsheets forecasting the companies they cover. Now, it's locked because you got to pay for the research. We don't pay for it at Maryland. But the point is, this is forecast for oncology, consumer healthcare, inflammation, sales international, domestic, sales of all their key drugs are forecasted by all of, these analysts. Bloomberg averages all of these forecasts to create what's called the consensus estimate. And this is a real-time view into what's called the consensus estimate database wisdom of the crowd on Wall Street. So the analysts forecast Pfizer. They upload their spreadsheets to Bloomberg. Bloomberg averages the spreadsheets. The average of all the analyst guesses is called the consensus estimates, which is the baseline for the cash flows of the company forecast going forward. So I can believe it's going to be up or down a little bit, but this becomes the value of the company. This is the value of Pfizer because there's an expectation that this is what they're going to do in the future for revenue, for profits, and eventually for free cash flow. So that's the point, is that this is actually why it's so hard to beat the market, because the market is not about performance. It's about performance against expectation. And Bloomberg is one of the few tools in the world that gives you Wall Street's expectation for a company. In fact, you're going to be seeing these screens later this semester for the companies that you're going to be evaluating, because you need to know what the baseline expectations are of a company when you do your cash flow evaluation. And the sell side that's actually doing it professionally will help us give us some insight into what's actually happening with these companies. But here's the point. If I showed you Tesla, which is now the second most valuable automobile company in the world after Toyota, which, if you remember, lost money and has never made money, you can't explain why Tesla, which has a negative spread, sorry, the computer's a little slow right now, but why Tesla, which has a negative spread of negative 1% ROIC against their cost of capital, why they are so valuable. And I can't either if I can't show you the screen. But what I was hoping to show you, and I seem to be locked out for some reason. There it is. Slow internet. There we go. If I go back to their competitors, or attempt to, what I was hoping to show you, custom spread. Tesla's market cap is $116 billion. They're worth more than Volkswagen, Audi, Honda, BMW, GM with this negative spread. You can't explain this. They've never made a profit. How could they be so valuable? I want you to look at this screen and I want you to look at row 13. That in billions is Tesla's revenue forecast for the next 4 years. This is last year, 2020, 2021, 22, and 23. This is pre-tax profit at Tesla by year. This is cash flow generated by, free cash flow generated by Tesla per year. So what I'm telling you is, if I think that they're going to be a $51 billion company generating $7.5 billion of EBITDA and $4.5 billion of free cash flow in 3 years, their valuation sounds a little less crazy. All right. Now, granted, they have to do this, but this is the realistic expectation of what Wall Street expects Tesla to do. So I just go back to let you know that this is what's going to start being important about, and this is the third cornerstone of valuation. We need to understand expectations and how that plays into value. Now, I'm not saying Tesla's going to do it, but regardless, if they don't achieve it, these estimates come down, their share price can fall pretty far, pretty fast. But I'm saying that, I'll give you another example. This is Amazon. This is Amazon's revenue last year, $280 billion. This is Amazon's revenue by organic growth without acquisition by 2023, $521 billion. By 2024, Amazon will be bigger than Walmart. And that's without acquisition. So part of the reason why Amazon's a $1 trillion company is right here. Okay. So as I said, we need to have a better understanding of the future when we do valuation. This is the third cornerstone. Okay. Fourth cornerstone. It's about competitive advantage. Over time, companies are going to be disrupted. They're going to go away. That was the point of this slide. You're going to lose your competitive advantage. So, two things. One, does a company have competitive advantage? Two, how long? How are we defining competitive advantage? We're defining competitive advantage as positive spread. Historically, competitive advantage was defined by what's called the moat theory. The idea is you have a moat around the castle to keep out the bad people. So what is your moat? Is it a patent? Is it a brand? Is it a cost advantage? Is it something? Because if you do anything good, people are going to attack you. You have to have a defensible position. But what's changing about our definition of competitive advantage is in the 21st century, what if I don't want to invade your castle anymore? Like, how many people on this phone, on this call, used to have a Nokia phone? And then a decade later, Nokia doesn't exist. And so what I'm telling you as a phone company, that now the definition of competitive advantage has been replaced by something called the wave theory, espoused by Rita McGrath of Columbia University. Those are her two books. But the point is, advantage is transient. Company's advantage is a wave. It's going to go away. So it's not a question of do they have advantage, it's how long, and more important, what's the next wave? What's next? So we have to start to understand that when we evaluate a company. So one other thing we should understand is some data that comes from Bain. This was published at HBR, but what it says is if you take a company, you take their current markets and their current capabilities or competencies, in this 2x2, these are the products and services that a company sells today. If a company takes those existing products and services and goes to a new market, odds are across all industries, only 1 in 3 of those growth initiatives make money. When companies actually grow into new markets that require new capabilities, odds of financial success drop to 1 in 20. So the other thing that we have to evaluate when we look at a company is that they say, oh, I'm going to go grow and do something. Growth, by definition, does not guarantee success. Matter of fact, average growth initiative loses money. It's actually hard to grow. But more importantly, if you grow into things that you don't know how to do, it's actually very difficult, and you actually have even lower efforts of success. So one of the reasons why Jeff Bezos has actually done so well at Amazon is that Amazon grows where they have capability. Meaning, if you think about Amazon's core capabilities, which are primarily supply chain and data, when they spend $1 billion to buy PillPack to do prescription drug delivery to the home, they already know how to do it. And they're going to be successful at it. And we're not worried about them getting that business. When they bought Whole Foods, they know how to deliver to the home. So delivering fresh food to the home is not all different than what they're already delivering to the home. So buying Whole Foods is within their competency, right? And so that's what we have to start to understand when we actually start evaluating acquisitions, okay? So, but regardless, growth is hard. And so that leads to key value drivers. This is something which this week's module focused on. And to some degree, the 4 cornerstones are based on the key value drivers. This is a summary of all the math that we're going to go through this semester. And at a high level, these 3 things determine the value of the company: spread, growth, and how long you can maintain the spread, and how long you can maintain the growth, because nothing lasts forever. That's your sustainability, and competitive advantage drives sustainability. Spread is return on invested capital times cost versus cost of capital, and return is a function of margin and productivity. So these become the value drivers for a business. Now, I've covered these slides, which says that we're defining in this class an attractive industry, positive spread. Competitive advantage, positive spread versus peers. If you are going to have competitive advantage, you have to be better than your peers. And that's what we're going to be talking about next week. Now, in the interest of time, I want to get to the math for this week and define a couple of key principles we're going to use this semester. So let's say we have a hypothetical company, which I'll leave hypothetically, that makes $100 million worth of no plat. or NOPAT. Those are interchangeable terms. So 100 million of after-tax profit from operations. I have two choices of what I can do with this profit. I can either put it back into the business, which is what we call the reinvestment rate, or I can pay it out to my investors, which we call the payout rate, dividend, share buyback, etc. Those are the only two things I can do with my profit, put it back in or reinvest it. For fun, we're just going to say, to keep it simple, 50-50. $100 million of profits, 50% reinvested, 50% reinvestment rate, 50 million, 50% paid out, 50% payout rate. These two ratios have to add up to 100% of total profits. Therefore, 1 minus the reinvestment rate is the payout rate, 1 minus the payout rate is the reinvestment rate. I'm now going to forecast the companies. To keep the math simple, 10% ROIC. The company made a 10% return on investment historically. It's going to keep making 10% in the future. That's just a simple assumption we're going to make. So if this company, which we're talking about in the previous slide, reinvests $50 million of its profits and makes 10% return on investment, it will grow $5 million in new profits next year. So down here mechanically, $100 million of profits becomes 105, because if we keep making 10%, we'll make 100 million in a core business. We'll get 5 million on the new investments. We'll get 105 of profit next year, 5% growth. That is known as G, which is the growth in profits. Now, or growth in cash profits, G, little g. I can shortcut G right here. G is also the reinvestment rate times the ROIC. I reinvest 50%, 10% ROIC, 10% of 50% says I can sustainably grow at 5% a year. So that's the other way we can get to a G. Now, the reason why this is important is because if I reinvest half of my profits, I end up with 50 million of free cash flow. Free cash flow is defined as profit after reinvestment. So I make 100 million of profit, I reinvest 50 million, I have 50 million left. Free cash flow is the theoretical payout rate. This is the cash, that's why it's called free cash flow, that I can distribute to my investors, and therefore, it's the cash that we use to value the company. A company is not worth the sum of its future profits. And the reason why it's not worth the sum of its future profits is because the company has to reinvest some of those profits to sustain and grow. So the company is worth the profits after that reinvestment, which is called free cash flow. So continuing on, free cash flow is defined as the cash from the income statement, which we'll specifically talk about in the coming classes, minus the cash reinvestment in the balance sheet. The difference between those two is called free cash flow. And so this, as boring a slide as it looks, is actually an important slide. So we're going to take this company we started out with, this hypothetical company, and we're going to say, okay, starts with 100 million of profits, it grows at 5% a year, and that's expected to continue. So its profits go from 100 to 105 to 110, etc. Okay? We have a competitor, which we'll call company B, which has identical profits, 100, 105, 110, growing at the same rate, expected to continue. So you got two companies, same profits, same growth rate, same cost of capital. Which of these two companies should be more valuable? Look at the data and tell me A or B, and why.
Is it B because they have higher free cash flow, which is more valuable?
Exactly. So that's the whole point here. B is more valuable because B gets more free cash flow. It's not more profit. Why does B generate more free cash flow?
Because of the low investment rate?
Yeah, they don't invest as much to get the same profits. And the reason the investment rate's lower is because they have a higher ROIC. Because I make 20% and my competitor makes 10, I don't have to put as much investment to make the same profits. Or if I put the same amount of investment at a higher ROIC, I would make more profits, but either way, I would have more free cash flow. This slide is a very simple way to show you that ROIC is free cash flow. If you generate a higher ROIC, caveat, for the same amount of growth, by definition, you have to have more free cash flow. And by the way, McKinsey is an ROIC company. What I mean by that is it's actually hard to forecast free cash flow. It's easier to forecast ROIC. They're the same thing. So one of the things we're going to do is we're using ROIC as a proxy for free cash flow. Tell me what your ROIC is. Tell me how fast it's going to grow. And that has to be, by definition, your free cash flow. That is what's summarized in key value drivers. So the whole point of the key value driver formula is if you're worth the sum of your future cash flows, free cash flows, and I discount them, I get a growing perpetuity. And so the growing perpetuity gets rearranged. This is the growing perpetuity rearranged. Free cash flow is profit after reinvestment. Profit times 1 minus the reinvestment rate. We know that growth is ROIC times the reinvestment rate. Therefore, the reinvestment rate is the growth over the ROIC. This is a rearranged growing perpetuity. This is the key value driver formula. And this was your homework assignment for this week. So when you did your homework assignment for this week, where did I put it? 758P. Do I have it in here? I don't have it. All right. So here's the point. I'll just do that. I'll recreate your spreadsheet really quick. This was the spreadsheet you were given. Basically, profit, growth, return, and cost of capital or risk. And you were given a company A and a company B. And it was already given to you, but basically you were given the data on that slide. Both companies had $100 million of profit. Both companies were growing at 5% a year. Company A had a 10% ROIC, B had a 20% ROIC, and they both had 10% cost of capital. What the spreadsheet did is it gave you this formula for value. So what you would do is you take profit times 1 minus the growth over the ROIC and divide that by the WACC, or the cost of capital minus the growth. And that was the value of A, and that was the value of B. And the other insight is that multiples, which is one of the last weeks of the class, are just a representation of value divided by profit. That's the price to earnings multiple, which is another way of saying multiples are just the rearranged cash flow equation. So multiples are actually based on cash flow. And ultimately, these are your key value drivers. So what happened when you increase the growth of company A? You did this assignment, but what happened? When I hit enter, I can grow at 7% a year versus 5% a year. What's going to change?
Nothing.
Nothing's going to
Okay.
change.
Why?
Because the ROIC is equal to cost of capital.
Your net present value is 0. So
Why does it change here?
Because the ROC is greater than the WACC.
Exactly. I call this the treadmill. You run really fast, you don't go anywhere, you don't create any value. So let me give you an example of this. So one of the companies that I work with in the real world is a company called Merck, MRK. And what I want to show you is historical financial statements for Merck, custom. So I'm giving you all public data here, but I'm going to put in ROIC and I'm going to put in WACC. So that is going back a number of years. And I'll go back from 13 to 18. Look at the spread. Is this company A or is this company B? What's Merck?
Closer to A than B.
Okay. Matter of fact, I'll put in growth if you want to see what the growth rate is. Growth, if I could spell growth. Growth, revenue growth year over year. So put growth in there. So tell me what should happen to the share price. What should we expect between 2013 and 2017 or 18 with Merck's historical share price? What should that stock chart look like?
Should it stay the same, Bo?
Straight line.
Well, if they're company A, and company A, you just told me is not going to create value, regardless of what the growth is. Let me look at a graph price of Merck from 2012 to 2018, March to March. Basically, their share price between 13 and 18 was pretty flat around 50. Bounced up, but came down relatively flat for a number of years. And I'm telling you, they were on the treadmill because this is the time period where that growth didn't matter. Not that they had any growth, they were actually shrinking. And they basically had negative spread. Now, here's the thing. Let me tell you about what's happening to Merck recently. Look at their share price to today. Tell me what happened between 18 and 19 and 20 for Merck. What changed?
Did they increase their ROIC?
See how easy it is to do valuation? That's what I'm saying. Like, these principles play out in the real world eventually, okay? Cash equals price, has to. You start making 17% a year and your cost of capital doesn't really change all that much, then suddenly that growth is valuable. Then suddenly start getting more interested in what's happening with your company. All right? So, scenario 3, I'll reset. What happened here? Company C starts slowing its growth. G goes to 3%. Now what happens?
Value is going to drop a little bit.
Why?
Because the growth slows down.
But why does the value drop? I understand the math, but what's actually happening here?
Well, your free cash flow is going to be going down, right? Because it's not growing the same amount year over year. So you're investing less at the same spread.
Absolutely. But what I want you to understand is this is the expectation cornerstone. And so what I mean by this is I price you as if you're going to make this spread and you're going to grow that spread at 5% a year. I realize I was too optimistic. And so therefore, you're not going to make this spread. You're only going to grow that spread at 3% a year. That's worth less cash. That's a lower multiple. Okay? So what you see in the real world with multiples, when company share prices either go down or their multiples contract, is people just expect that they overshot. I priced you as if you're going to do better than you did. I realize you're not going to do as well. I have to reprice you lower. Right? It also says, by the way, watch what happens when G goes from 7 to 6 to 5 to 2. As companies mature, their multiples contract. As companies mature, their multiples contract. So here's what I mean. I'm going to go out and pick a company in the real world that I work with called Google. So here's Google. Here's their earnings estimates for the next 4 years. What I want you to look at is the PE ratio. This is price to earnings ratio right here, based on 2020 earnings. So today's price divided by 2020 EPS, 2021 EPS, and 2022 EPS. Notice what happens. Price to earnings multiple for next year, 22, then 19, then 16. All right. The reason why is because Google's growth rate is expected to slow. Last year, they grew at 19%. By 2023, they're only growing at 15 a year. And what I'm telling you is as this growth rate slows, their multiple will contract. That is cornerstone 3 of the value creation. That's the third thing that you did. And that plays out in the real world. In fact, it plays out for the S&P 500 index. Right now, if I look at the S&P 500 index today, because essentially Wall Street is forecasting 500 companies which get aggregated. This is the PE on the S&P 500 today. So as awful as people think what's happened to the market going down by 20% in the last few weeks, it's still a PE of 18. So I'm just saying, we actually have gone back down with the market correction to a long-term normal price to earnings multiple for the S&P 500. So if people wonder, can the market go down further? Oh, yes, it can. Because that also assumes that the analysts don't cut the earnings targets, because the earnings targets have not yet been cut based on what's happening with this coronavirus. So if I cut the earnings targets and I don't see the growth, we actually see further declines in the S&P 500. But by the way, based on earnings targets, it's a PE of 12 on 2 years earnings, 12.92. Because as the growth slows, and the market is expecting slowing growth over time, PEs do start to come down over time. So just something to keep in mind as you think about valuation later when we get to the multiple section. And then scenario 4 was what happens when we grow a negative spread? What happens here? What was the 4th scenario to your homework assignment?
It's going to go down even more. You're destroying value.
Exactly. Hey, doctor, my head hurts. Why is your head hurt? Well, I'm banging it against the wall. Stop banging it against the wall. So 7 becomes 3, becomes 0, becomes -3. If you understand these scenarios, and particularly what changes with these key value drivers, you'll have a basic concept for the entire semester. This is what we're going to focus on, because this tells me what's going to happen to the intrinsic value of the firm. These are the 4 scenarios. And if I understand how those 4 scenarios play out, I'll at least conceptually understand what's happening with the company and why their valuation is going up or down and why the market is going up or down. So tell me what's happened in the last 30 days. Why is the market down 20%? In the context of the key value drivers, what is changing about the S&P 500 or the Dow Jones Industrials? What's changing?
Would say the expectations, so that third value driver. So
I'm talking about in terms of the KVD. Looking at these 3, what's changing is the combination of these 3.
Well, growth and cost of capital, I guess, if they keep cutting rates and banks start actually repricing that.
Okay. So first of all, what's happening to growth? Let's break it out. growth up,
Growth is
down,
slowing down.
slow. So if growth is slowing, if companies aren't going to grow as fast, you're worth less. Cost of capital. Now that one's a little bit ironic, okay? And here's what I want to show you. And this, by the way, should scare the hell out of you, okay? So this is the yield curve right now for US Treasuries. You guys probably took finance. This yield curve is completely screwed up. It's inverted twice. Okay, we're not just inverted once, we're inverted twice right now. So this is the yield on US government securities across all durations. So if you borrow for 3 months, you get paid 80 basis points. If you borrow for 2 years, you get 62 basis points. If you borrow for 10 years, you get 91 basis points. And if you borrow for 15 years, you actually get 88 basis points. Okay, we're inverted twice. Now, why is an inverted yield curve bad?
Signs of recession.
Why? I agree with you, but why?
Doesn't it mean that there's more risk in the future than right now?
Yeah, it basically means you're paying, it's actually the opposite. There's more risk now than in the future. I have to pay me more to hold money for 3 months than to hold money for 1 or 2 years. It's backwards. All right, that's the whole point of the yield curve. People think times are worse now than they are in the future, and it's going to get better in the next couple of years. But here's why this matters. This was the yield curve 30 days ago. This is how much interest rates have fallen in the last 30 days. This is everybody selling equity and going to cash. All right. So what's interesting is you can say, well, gee, that technically should be lowering the cost of capital because risk-free rates have gone down. But the key to cost of capital is uncertainty, because the risk premiums and the beta are all based on uncertainty. And what's happening is, what's ironic is for companies, cost of capitals are going up, because if you are pick a company, I was with Union Pacific last week. If you're Union Pacific, these are your borrowing costs today. These are your borrowing costs versus the US government. And so what's happening is your borrowing costs are getting higher relative to risk free. The risk premiums for your debt are getting a lot higher. And if you want to see something really scary, I'm going to add in Royal Caribbean. These are the borrowing costs for Royal Caribbean, because Standard & Poor's just cut them to junk bond. And so now the cost of their debt is spiking, or at least the lowest triple B. I think they were single A to triple B. They're right on the verge of junk bond, because basically the government's saying, don't go on cruise ships. And if you watch the news, you don't want to be on the cruise ship, basically, which is a prison ship, once the coronavirus is on there. And so their borrowing costs have spiked while the government has gone down. So what's ironic is, even though risk-free is low, the market's actually using high cost of capital for these companies, which is another reason why prices are coming down. So we got slowing growth, we got cost of capital coming down, and likely ROICs are probably going to trend down. The question is how much. That is what the market's trying to figure out, and that's why stocks are down 20%. Okay, but essentially it's the principles at work. Now this is going to settle out in the long term. We're probably going to overshoot in the short run, and so want to buy airlines? Buy airlines in about a month when they're down 40%, and in 5 years you're going to be thrilled, because air travel is not going away long term, and it's probably good if you can buy them and you have the cash to do it. I just don't know where the bottom is going to be, right? Because we got to figure out what's going to be long term, short term, but that'll be something maybe we'll talk about the next few weeks. But as I said, understanding key value drivers is understanding what we're going to really talk to you about this class. 4 cornerstones, key value drivers. I know I've been monologuing. Questions about anything? related to these assignments. Question related to the homework. Question related to the market. Question related to any companies.
How do we access the Bloomberg terminal?
You pay Bloomberg $25,000 a year for the software.
All right.
That's option one. Option two is we actually have terminals at College Park and at remote campuses, which are available for students for free. We actually have 60 terminals that students can use for free, but you'd have to physically go to College Park to actually access them. So unfortunately, that's one of the advantages of the in-person class is they actually take this class in the Bloomberg lab and have access to the terminals throughout the class. Now that's a great equalizer because campus is closed for the next 30 days. So they lost access to all the software for the next 30 days. But nonetheless, I will throughout this semester be giving you data. But the reason why I'm giving you data out of Bloomberg is because, as I said, I don't know if anybody in this class is actually using it, but it's literally the pro tool. So it is the tool that Wall Street uses. It's the way that they access the data. It's what they see. So I want you to see what Wall Street sees as we actually start evaluating companies. Other questions about the assignment, key value drivers, anything that we talked about this week, what it means, how it applies.
If this is like really as simple as it is, why does it seem so complicated when I watch people talk about this on TV and try to explain things? Like, well,
I'm gonna give you two answers to that question. So first is the Einstein quote. So Einstein had a great quote, which I'm going to paraphrase. A person's understanding of a subject is inversely related to their ability to explain it. Most talking heads on Wall Street, no idea what they're talking about. They're idiots. Now they're rich idiots, but they're idiots. And that's the point. They hide behind language, they hide behind lingo, or they're guessing. There's some very smart people on Wall Street. But what I'm also telling you is finance does not have to be that complicated. We overcomplicate it, but it doesn't have to be that complicated. The core principles are very straightforward. And so that's the point. If you understand the core principles, you have a general idea of how things are going to work. And what I'm going to tell you is that none of the math you're going to learn this semester is something that I can't teach in algebra. Like we can have 10th graders doing the same math you're doing. It's not advanced math. That's not the hard part of valuation. This is the hard part of valuation. If I go back to Tesla, and I go back to their revenue forecast, which is what the analysts have to do, tell me how many Model 3 cars they're going to sell in 2021 with certainty. Tell me how many Model 22 cars they're going to, or Model 3 cars they're going to sell in 2022 with certainty. And by the way, at what price, right? See, that's the art of valuation. The math is not the hard part. It's figuring out what assumptions to put into the formulas because we're dealing with the future. And that's the expectation cornerstone, is that you're worth the sum of the future. So how do we understand the future of the company? I'll give you another example. If I'm doing Merck, if I'm forecasting Merck is 100 drugs. These are the 100 drugs that Merck sells from Keytruda, which is 14 billion a year, going to 20 billion a year in 3 years, to B114, which will launch tentatively in 2021, and by 2023 be $150 million a year in revenue. See, this is what I'm actually forecasting when I forecast Merck, because I have to forecast all these drugs. That's Merck. And so that's what's hard, is I can do this, Merck's what's their overall company? And I add it all up together, they're a $50 billion company, so maybe they'll grow 5% a year. It's kind of arbitrary, right? So if you really want to get granular, Tell me what's going on with Keytruda. Tell me what's going on with Gardasil. Tell me what's going on with Zetia, which went off patent a couple of years ago and used to be a $2 billion drug and now is a 2 billion, 2.5 billion, and then now is a 1.3 billion, and then 360 million. So the point is, I need to understand what's happening with the company. I need to understand what's happening with their products and services, and to some degree, a forecast of their future. And I had to put that forecast in. That is the art of valuation. And that's what we're going to practice throughout the semester. So that's where we go to next week with EIC, because we got to understand what's going on with the economy and how that's going to affect the companies. That's why the interest rates, as I showed you, start to become very important. You know, we got to start understanding the industries. So what's happening with these industries? You know, for example, if I had my students today look at Caterpillar, and last week we looked at Halliburton. So has anybody heard of Halliburton before?
Yep.
If you haven't heard of Halliburton, this is Halliburton. So they basically sell stuff, construction and engineering, primarily to the energy industry. Okay, that's their business. That's what they do. Okay, so here is Halliburton share price for 5 years. Okay, now you can see their share price is falling like a rock. And here's part of the reason. This is where we get to EIC. So what I'm going to do is I'm going to put up here, I'll put up fields, and I'll put in revenue or sales. So this is Halliburton's normalized sales and revenue, hopefully. I'm going to add it to it. Should have added to it. There it is. There is Halliburton sales quarter by quarter going back to 2015. And what you'll see is generally when their sales dip, their company share price dips. When their sales improve, company share price improves. When their sales dip again, the share price dips. What do you think is going to cause their sales to go up or down?
I mean, the value in the energy industry.
And their biggest clients are the oil and gas companies.
Right.
So let's look at prices for oil. And what you can see is their stock price pretty much tracks oil prices. And so as oil prices have plunged, and today they're right around $30 a barrel, Halliburton's stock price has fallen off the table. Because historically, when oil prices go down, the Exxon Mobils, the Shells, they don't spend on new construction services, and their revenue tanks. So this becomes a leading indicator of what's going on to their share price. This is EIC. Okay, this is what we're going to start talking about next week. Because if I understand what's happening in the economy and the industry, and I can start to link that to the company, then I'll start to understand how my assumptions for valuations will change. Right, and that's what we need to have a better understanding, because that's really what the market is about. Right, it's not going to be as clear cut as it is for a company like Halliburton, but that's the point. I need to know not just what's happening in the market today. I need to think about the industry itself. Okay, so in the airline industry, it went from 10 airlines to 4 airlines over a decade through consolidation. Did that help or hurt consumers?
Hurt.
Yeah, because we lost buyer power. We lost choice. Why do you think they all charge fees? And up until today, we didn't have a choice about paying the fees. Because where are you going to go? And they're all charging the same fees. So that's the point. Like, the industry got much more favorable when they eliminated competition. And when they all decided that collusion was better than competing. When they all decided that rather than basically adding new planes, what they were going to do is just stuff more seats into the existing planes. And they were going to limit capacity and raise price. So understanding that industry structure is why take an airline like Delta, and you can see, FA, over time, why Delta's ROIC, which used to be horrible, now used to be single digits, been averaging 25, 26%, 16, 14, 16. Two things happen. Number one, 22% of an airline's cost is oil prices. So when oil went down, the airlines made a ton of money. So they're about to be very profitable via oil. Problem today is nobody's flying. And then the second thing is when they generally, until the crisis of today, the virus crisis, basically, when they basically colluded and decided to hold back on capacity, took the power away from us, it made the industry much more favorable to them. So just the environment has changed, and the environment is changing again in real time today. And we got to figure out what that means to airlines when no one wants to fly, and how long it is before people start flying again, because that's what the panic is that's driven their share price down 20% in the last 3 weeks. So again, these are the types of things which we're going to get into in EIC. But the long answer to the very short question is the valuation math is actually relatively straightforward. The book lays it out very clearly, but figuring out the future is not so easy because we're forecasting. So part of what we're going to talk about this semester is how do we get better at understanding the forecast and how to forecast. So I'm going to teach you a process by which we will do that. Other questions, comments about any of the content, either today, in the book, in the class, something you've read?
Are there any good resources for learning some of the shortcuts that you're using in the Bloomberg terminal?
Do you have a terminal?
No, but I might go to the one on campus.
Yeah, I would definitely try and take advantage if you can. I would say that the terminal itself has some tutorials which you can download on like quick uses, but I can post some of the shortcuts that we're using in this class because we're actually the #1 user of Bloomberg in higher education in the world at the university. There's no other university in the world that has 60 terminals. We have the most, and there's no other university in the world that has 32 of them in one classroom, which is what we have. It's a privilege. So Bloomberg gives us a lot of attention. And so one of the things they did is they actually did some advanced training for my students a few weeks ago. And I'm happy to post up what they did. So I'll give you an example. So one of the features that Bloomberg changed a couple of years ago was because of a company called Snap. And I don't know if you're familiar with Snap or use Snap, but 2 years ago, if you actually look at, oh, this is Delta, Snap, which is Snapchat. 2 years ago, Snapchat's stock price went down dramatically. Matter of fact, in one day, it went down really dramatically. Does anybody know what happened here in early 2018 that destroyed their share price?
Didn't they change their app?
Nope, it was actually something just more benign than that.
Didn't one of the Kardashians like say they weren't using Snapchat or something like that?
Yes. So they had paid a lot of money for the Kardashians to be brand ambassadors, and their brand ambassador, one of the Kardashians, I think it was what's her name? Doesn't matter. I don't know them. But basically, the Kardashian woman was Kylie Jenner. She tweeted that she wasn't really using Snap anymore. And their share price cratered, cost them $1.5 billion of market cap. So it was the tweet heard around the world. So what Bloomberg started to realize is that basically all of this information is a leading indicator. So they created this section called Trends, TREN. And I'll do it in the last 8 hours. This is the biggest increase in news about companies that's been happening. So Boeing is canceling 737 MAX orders. And by the way, if you saw today, Boeing maxed out their credit line because Boeing's pretty screwed right now. Okay, nobody wants to buy their planes, and the government also pushed back the delay of the 737 because I got to rewire every single plane in addition to the other fixes. But what they also have in here is new sentiment. So in the last 8 hours, and I'll just go to security list. If I actually look at the S&P 500, these are the companies that have the most negative news stories about them on the S&P 500. And these are the companies that have the most negative tweets against them in real time in the last 8 hours, as well as news volume, et cetera. So going back to, if you're using Bloomberg, it's called TREN, but the analysts are actually using this because they're actually starting to look at, basically, companies are actually reporting bad news or people talking about bad things about them, then eventually it might be a leading indicator that I had to change my revenue or other forecast about a company, right? So that's just something to consider. And then for the environmentalists out there, if you're doing a company, like who's somebody you guys work for that's publicly traded?
Marriott.
Marriott. So if I look at Marriott, this is the new thing that this is past my age, but it's called ESG investing, environmental, social governance. So this is important because BlackRock, which is one of the largest money managers in the world, their CEO has said they're going to start using ESG scorecards to invest in companies. And basically, if you do poorly on ESG, then they may not want to put you in their portfolio. And ESG stands for environmental, social, and governance scores. And this is the actual score of Marriott that Wall Street is using for their environmental, social, and governance score. And so Marriott is basically doing worse than their peers in environmental, worse than their peers on governance, but better on social. So what's going on with Marriott? Environmental is basically how much pollution they're doing as a percentage of revenue. They're really bad at that, okay? But they actually have more women. Their employees like them more. And they have, I guess for whatever reason, more unionized employees, but they got poor corporate governance compared to their peers. So again, these are some of the other things we can start looking at companies, because increasingly some funds are now will say, I'm not going to invest in Marriott because of their ESG score. This is new. This is something that's just been popping up in the last year, but it's starting to become important to investors. So again, some things we'll be talking about as we go through EIC. And that's again next week. All right. So what you need to do before next week is basically read the materials of the book, watch the videos, and then practice the EIC assignment on the company that's in the homework. And then basically I will, in class, we'll cover that. We'll talk about that more. But as I said, later in the semester, the 3 teams are each going to get 3, you're going to pick 3 companies. Marriott could be one of them if you want. And then you're going to do a real world valuation for half your grade as a team. Final class, you're going to present that. So here's the point. When we do EIC as a company, as an assignment in week 2, then you're going to do EIC on the company you choose as a team, which you'll present in week 7. Okay. So you're going to be doing this analysis on a real company as well. Actually, 2 real companies. One next week, we'll do it together as a class. One in 6 weeks as part of your final project. So I need everybody by next week to be on a team. Okay. So that was one of the homework assignments for today. So let me go back and let's talk one more time about the teams. So it's under people. For grade, these 4 people need to be on teams. So next week, these 3 groups will pick teams. And I'll basically, as long as we're not talking about it in class, you can pick them as somebody to value. And I will get you the data from Bloomberg. I'll post it here on Elm so you'll have access to it. And then you'll start to use that to do your assignment. So we'll do terminal by proxy. All right, but before we wrap up today, any final questions, comments, concerns, crippling fears?
So I have a question. So I can't go down to university to access Bloomberg Terminal, but there are free alternatives that pop up when you search Google to Bloomberg. Is there any? Do you recommend any, or do you have any experience with any?
The rest of them kind of suck. And I'm just being candid because it's kind of like you're asking me, is there an alternative for Facebook for Facebook? And the problem with the non-Bloomberg sites is that everybody's using Facebook and no one's using the other sites. So you're using something that nobody else is. And I'm not saying it's bad, but it's not like Bloomberg is a system of record. And Wall Street is actually sending data to get data back from Bloomberg. So if I pull up the ROIC of a company, I know that Barclays and JP Morgan and Goldman Sachs are all using the same information. And that's important to me if I work for Vanguard. So that's the one advantage of a Bloomberg terminal is it's basically, it's the standard. So other systems can try and replicate it, but it's kind of like saying, I'm going to get a FICO score, but I'm going to use one of those other sites that's not the FICO score that's trying to figure out the FICO score that the lender's not actually going to use. You might be in the ballpark, and it's a whole lot cheaper, and it might be what you get. But, if nothing else, for our purposes, I'm going to give you data based on the industry standard. But I wouldn't pay a lot of money for the other services. So for example, the competing services, there's two primarily. There's one called Thomson Reuters, which costs $1,000 a year. I still think that's expensive. And it has, 1/10 of the information in Bloomberg. And there's another one called from Standard & Poor's. They have an alternative called, I forgot what it's called. Standard & Poor's is, I'm losing my mind, but they have one that's $5,000 a year. And I wouldn't recommend paying that much for either one unless you're a professional. You can look up Google Finance, Yahoo Finance. The problem is you're not going to get access to the future estimates. That's the stuff that's a little bit more golden. Yahoo is a little bit of that, but like when we talk about beta, it's a different beta than what we're going to use. So anyways, last but not least, this class is being recorded. I'm doing screen capture and video capture. At the end of each section, and there's another section at 8:45. So at the end of both sections, I'm recording both sections, and I will post them to YouTube. And then I will put the YouTube video links on the homepage of our site. So if you need to go back and review anything, this has been recorded, and it will always be recorded. If for some reason you can't make a class, you can always watch the video of what was recorded during the class. If for some reason you need to go to a different section, we're covering the same material in either section. So I had somebody tonight who said, look, I'm running late. Can I go to the 8:45 section? It's okay for the first 6 classes to do that. However, for the final class, this group project is based on the section you're registered for. And you have to present during that final week in the 7 o'clock section. So every now and then you could serve the 8:45 section, but your team is going to be in the 7 p.m. section, responsibility for assignments in the 7 p.m. section, and your group projects will be delivered during the 7 p.m. section 6 weeks from today. Okay. If for some reason you get the virus, you get sick, you need extensions, please let me know. Because obviously, we got, in addition to flu, we got some other horrible stuff going on. And, hopefully nobody gets it. This is an online course. Hopefully it will continue to be online. I hope I don't get sick, knock on wood. But regardless, if you do have problems, please let me know and I'll try and make whatever accommodation we can. All right, so that's it for tonight. I'm going to close out our webinar. Look forward to seeing everybody in 1 week. As I said, make sure you do the assignments for Module 2, do the readings, and finish. It's all on EIC, and then come prepared next week to talk about EIC. Have a good week. Take care.
Thank you.
Bye-bye, everybody.
Thank you.
Bye. Thank you.
Bye.